All right, Juan, we're about a minute and 15 seconds out. I'm going to go ahead and stop share on my side. If you want to click that
Okay.
share screen button, and we'll make
Yeah,
sure
just a
everything.
minute.
Oh, yeah, sure.
Be right there. I'm just putting my jacket on. Ask you a question.
All right, screen share looks good.
Oh,
All right, everyone, welcome back to Money Show's Virtual Expo. We are pleased to welcome Juan Leon, Senior Investment Strategist at Bitwise Asset Management, where he helps lead research, product and strategy development, fund and index management, and supports sales and client relationships. Before Bitwise, he was a portfolio manager at U.S. Global Investors, where he managed equity and fixed income funds and designed quantitative investment strategies. Juan also earned the Chartered Financial Analyst designation from the CFA Institute. Juan, thank you so much for joining us today. It's all yours.
thank you very much.
We're ready when you are, Juan.
Should we get started or are we waiting until the top of the hour?
Oh, we had a 11:55 start time,
Oh, great. My apologies.
so you're good to go.
Great. Well, thank you everyone for being here with me. Today, we are going to talk about crypto and what all happened in Q2. It was an exciting quarter. There's always a lot going on in crypto, and Q2 was no exception. So let me first start by showing you our agenda. I'm going to talk to you briefly about who we are at Bitwise, and then go into the 10 biggest noteworthy developments in Q2. Then we're going to dive deeper into the data and the trends to uncover the key trends and fundamentals for the quarter, and then look outward into Q3 for upcoming catalysts. So let's get started. Well, at Bitwise, we are a global crypto asset manager. For those of you that are not familiar with us, with over 15 billion in assets under management, we were founded in 2017, and our flagship fund is the world's largest index crypto fund. Now we have a suite of different solutions that span private funds to publicly traded ETFs, to hedge fund strategies, to treasury management strategies, staking services, the whole gamut of asset management in the crypto industry. And we are known for our research and client service. Our CIO, Matt Hogan, co-authored the CFA's Institute's Guide to Crypto. We primarily focus on advisors, institutions, hedge funds, and family office, institutional investors at large. But we work with retail clients as well through our ETFs. And we do one thing and one thing only, which is focus on crypto 24/7. We have a team of over 100 professionals and distribution experts in all of our geographies to work with clients on their crypto solutions and gaining access to the opportunities in crypto. Here is an example of some of our materials. Here's the CFA, a picture of the CFA guide to crypto that I mentioned. And one thing I'll point out, if you want to stay engaged with what we do, we have our CIO writes a CIO memo every week. It's a easy 5-minute read that keeps you up to date with the market. So if you'd like to get subscribe to that, please go to our website and look for the subscription to the CIO memo. All right, let's dive into what happened in Q2. It was a big quarter with lots of different developments stemming from M&A to the performance and new innovations in crypto assets to trends with stablecoins, tokenization, Bitcoin treasury companies. There's a lot to cover, so let's dive in. The first thing that happened is that stablecoin summer kicked into high gear. We saw the explosion of Circle in public markets as it went public, becoming the best performing IPO over the past decade. This happened just as the Genius Act, which we'll cover later as well, a stablecoin specific legislation bill, moved through Congress and got signed into law. And this really sets up stablecoins to become adopted mainstream for payments, for payment use cases. And that is something that we are very excited about. Now, crypto treasuries are something that started with MicroStrategy in 2020 when it decided to convert its balance sheet to Bitcoin. But this is a trend that has really been gaining momentum over this past year, and especially in 2025, where more companies have adopted a Bitcoin treasury policy to adopt Bitcoin into their treasuries. And in Q2, we saw an explosion of that with crypto treasury companies growing 50% quarter over quarter, buying cumulatively 160,000 Bitcoin, which is basically the entire year supply of new Bitcoin in the market. The Bitcoin network is currently producing 165,000 Bitcoin per year. And Bitcoin treasury companies acquired 160,000 in the second quarter. So this has become a huge driver of institutional demand for Bitcoin, along with the flows from ETFs, which we'll touch on later. Now, Bitcoin is big, but ETH is getting its groove back in Q2. ETH was the top performing crypto asset among large blockchains. It rose 38% in Q2, outperforming Bitcoin, XRP, Solana, and others. And this is in large part as the stablecoin trend that I was talking about earlier kicked into high gear. The majority of stablecoins today are transacted on Ethereum, and along with the majority of tokenized assets, which we'll touch on later, that are also being built on Ethereum. And this has really propelled ETH into the mainstream consciousness for institutional investors looking to get access to crypto beyond just Bitcoin. M&A deals are picking up as the space heats up. In Q2, we had a couple of significant deals. Coinbase announced the acquisition of the derivatives platform Deribit for $2.9 billion. Robinhood completed its acquisition of Bitstamp, which gives it a foothold in European and Asian markets through its established exchange operations in Europe. Ripple agreed to acquire a prime broker called Hidden Road for $1.3 billion. CoreWeave, an AI hyperscaler, announced the acquisition of Core Scientific, a Bitcoin miner, in a large deal as well. Those were just some of the deals that we saw in the space, and we see M&A continuing to build this year as more established companies look to get a foothold in crypto. Now, Coinbase is the juggernaut of the crypto space, largest exchange, but it's going beyond. It's becoming more than an exchange. It now has many other business lines that it's incubating and that it is offering, from custody to staking to a layer 2 called Base, which is the largest layer 2 on top of Ethereum, offering a host of crypto applications. And in Q2, we had a huge milestone where Coinbase was the first crypto native company to join the S&P 500. This is a huge validating moment for the space. It signals the mainstreaming of crypto, the institutional adoption of crypto. And it also means that everyone who holds an S&P 500 fund or a fund indexed to the S&P 500 now has exposure to crypto through Coinbase in their portfolio. Now, the increasing adoption of crypto has led to their inclusion as an investment option in some employer-sponsored 401k plans. This represents a significant development for the crypto industry as it goes into mainstream adoption. Initially, this had been discouraged by stricter guidance, but now a reversal in policy has made it possible for 401k plan sponsors to include crypto investments. And this is a big deal because retirement funds manage huge sums of capital, trillions of dollars, and this is permanent capital, long-term minded capital. And as this becomes more ubiquitous in 401k plans, then this is new capital flowing into the crypto ecosystem, which is beneficial for growth and institutional adoption. And we got a new pro crypto chairman with Paul Atkins. This is a great development. His administration is ushering in a complete reversal to the Biden era SEC. And what has happened since then is all of the major lawsuits have been reversed against crypto companies. New products are being greenlit. Just last week, Paul Atkins came out with a speech called the Project Crypto speech, where he ushered in a vision for a new innovation to be possible in the space. New guidelines in order to allow staking in funds. Faster listing requirements are being proposed by the SEC. So this is really catapulting the industry to be able to offer more products for investors that increase the exposure that you can access. And this is catalyzing new adoption in the space and regulatory clarity, which the industry has been looking for many, many years. We had some major announcements from trading giants, including Coinbase, Robinhood, Kraken, and others, who announced bold visions for tokenization. We'll talk more about tokenization, but this is an area of huge growth, bringing real-world physical assets such as bonds, stocks, and other types of assets on chain. This is going to allow the financial system to upgrade from trading that happens in traditional financial markets today, Monday through Friday, to be able to happen 24/7, bringing down costs, increasing efficiencies, and blending the worlds of crypto and traditional markets. So these platforms are all working on tokenization initiatives, and we are very excited about what this means for the space. Now, beyond this, traditional financial firms are also integrating crypto into their offerings. Shopify announced a deal with Base, which is the layer 2 scaling solution, which we'll talk about more, built on top of Coinbase, in order for customers who check out on Shopify to be able to check out using crypto on Base and also be able to access the applications on the Base platform. We also had another announcement from MasterCard, working with Chainlink to be able to purchase crypto assets on decentralized exchanges such as Uniswap directly with your credit card from MasterCard. This is the first time something like that has been announced, and it all shows the momentum that the industry has in entering the mainstream commercialization phase. Lastly, before we move on to the key trends and fundamentals, Bitcoin had an incredible quarter in Q2. It was up 31%. That outperformed the S&P, which was up 11%, gold, which was up 6%, bonds, which were up 1%. So again, showing leadership in terms of an asset class as adoption, institutional adoption, spurs performance forward. Now, let's talk about some of the key trends and fundamentals that we saw this quarter. So here we have a chart of the transaction count of Ethereum and its layer 2 ecosystem. And so you can see that we are reaching new highs here. First of all, let's talk about what are layer 2s. Layer twos are scaling solutions that sit on top of Ethereum and essentially batch transactions in order to make Ethereum more efficient. As I mentioned, in Q2, Ethereum was up 38%, the best performer among large blockchains. And Ethereum is that performance is being driven by the recognition that Ethereum is emerging as a decentralized app store for crypto and is benefiting from the growth of stablecoins, of tokenization, of decentralized finance, and other types of applications. As I mentioned earlier, the majority of stablecoin transaction volume today goes through Ethereum. The majority of tokenized funds are being launched on Ethereum. And the majority of DeFi runs through Ethereum, decentralized loan origination in applications like Avid, trading in decentralized exchanges like Uniswap, staking, retail staking in apps like Lido. I mentioned the partnership between Base, the layer two on Ethereum, with Shopify. So all of these things are driving activity on Ethereum and its layer two ecosystem. And that is why we saw transaction count hit a new high in the second quarter. Now, stablecoins also hit a new high this quarter, nearing 250 billion. And just to take a step back, stablecoins are digital dollars on blockchains. So they are fiat currencies like the dollar represented as a crypto token that transacts on a blockchain. And for every dollar that is issued on a blockchain as a stablecoin, there is an equivalent physical dollar that is held one-to-one in reserve, and these dollars are invested in US treasuries. So the benefits of stablecoins are that right now, merchant fees at the point of sale are up to 3%. Bank wires take 2 to 5 days. And with stablecoins, you can have 24/7, 365 instantaneous settlement at zero fees. And that is what is catalyzing the adoption of stablecoins for payments use cases. There's also regulatory clarity emerging for stablecoins. As I mentioned, there's a number of regulatory bills going through Congress. We'll get into this later, but the Genius Act passed into law already, and that is a stablecoin specific bill that is propelling stablecoins into mainstream adoption. And the other thing about stablecoins is that because they are backed, their reserves are backed in treasuries, they are becoming among the largest buyers of U.S. treasuries. Currently, they're about the 15th largest buyer, but Scott Bessent from the U.S. Treasury projects that stablecoins could scale to 4 trillion from the current 250 billion by the end of the decade. That would make stablecoins the largest buyer of U.S. treasuries, which is a great supporter of the treasury market, especially as large buyers like China and Japan step back from that market. Now, here's another chart showing the growth of stablecoins. As you can see, before 2020, stablecoins weren't even around, and in just a few years, they've scaled really quickly to where in 2024, as you can see on the chart, in green, stablecoin transactions surpassed Visa payment volume for the first time. And in 2025, in the first quarter, it's already running way ahead. So what is driving this? It's the mainstream commercial adoption. It is Meta that is looking to adopt stablecoins into its ecosystem. Stripe has already embedded stablecoins in its and its offerings to its merchant platform. It actually acquired a large stablecoin provider called Bridge last year or earlier this year. Shopify, as we talked about, is embedding stablecoins through the Base application. PayPal has launched its own stablecoin. Amazon, JP Morgan, the banks are looking into stablecoins. Citigroup, Bank of America, they've all announced stablecoin initiatives. And so stablecoins are now growing beyond competing with Visa, and they're on their way to becoming larger payment rails, much like Swift. And the ultimate winner of all of this is the U.S. consumer, because this will bring down the cost of transacting, and it will make it easier to transact all around the world. Now, the tokenization of real-world assets, as we see here, is accelerating. This growth is hitting a new inflection point. And so tokenization, what it is it's bringing investment assets from the physical world on chain. This is things like US Treasuries, like private credit, like commodities, stocks, venture capital funds, real estate, all of these real world assets, they're starting to be tokenized and brought on chain. The benefits of this is that it opens up new investor bases and liquidity. It fractionalizes ownership. It reduces barriers to entry and democratizes different types of investment assets to a broader public. As I mentioned, Robinhood, Kraken, Coinbase have all announced tokenization platforms that they are building. And this is a multi-trillion market opportunity. By some estimates, the addressable market for this is 500 trillion in the opportunity to bring tokenized assets on chain. Currently, the amount of tokenized assets is sitting at about 25 billion, as you can see on this chart. So the opportunity is huge, and that's why some of these large firms are looking at this and working on this opportunity. Now, crypto equities, in addition to crypto assets, there is a growing ecosystem of publicly traded companies that are building products and services for blockchains. As you can see here in green, crypto equities are the fastest growing segment of the equities markets compared to other sectors. This is a chart of the 2025 estimated full year revenue growth. And you can see that crypto equities have a projected growth of above 35%. And their closest peer, information technology, is about 8%. So they're growing really, really fast. This includes companies like the Bitcoin miners that validate transactions and secure the Bitcoin network. It includes companies like Circle, which I mentioned just recently went public and has become the fastest growing IPO of the past decade. It includes companies like Coinbase. And so this is we think crypto equities provide the opportunity as we think of them as the picks and shovels that are benefiting from the rapid growth of blockchain adoption and building services and products in the ecosystem to propel it forward. Now, we talked about the explosion in crypto treasury companies. Here we see the quarter over quarter Bitcoin holdings of Bitcoin treasury companies. And this is also hitting a new high. As I mentioned, in Q2, Bitcoin treasuries, corporate Bitcoin treasuries bought almost 160,000 Bitcoin. That was a big jump from Q1, where they bought about 90,000, and it's continued scaling, as you can see there. Now, this is probably the fastest growing subsegment of crypto equities, driving significant demand for Bitcoin. These companies are turning to Bitcoin to protect their balance sheet against the devaluation of the dollar due to inflation and central bank money printing. And they recognize that Bitcoin also allows them to turn their balance sheet into an asset that can also drive growth for the company in addition to the income statement. So it allows them to monetize the balance sheet as well. Strategy was the pioneer of has been the pioneer of monetizing its capital structure, issuing equity to buy Bitcoin, issuing debt, issuing convertible securities. And now this is a trend that's going beyond the US with companies all around the world, some of those being Metaplanet in Japan, the blockchain group in France, Melius in Brazil. They're providing local access to their investors to the growth in Bitcoin. And in some of these emerging market countries, inflation is really, severe, double digits in some cases. So having a publicly traded vehicle that investors can access to get exposure to Bitcoin is a really, really sought after exposure. So this is a trend that we see accelerating. But it's not just corporations that are buying Bitcoin. It's governments increasingly getting access to Bitcoin too. There's now more than 10 governments around the world that own Bitcoin. Some have acquired it by asset seizure, but others are, like Bhutan, are mining Bitcoin. Some are buying it themselves, like El Salvador, like Abu Dhabi. And it's going beyond the sovereign level. At the state level in the US, for example, there's over 20 states that have proposed strategic Bitcoin reserves, like the one adopted by the US government. And Bitcoin is being seen increasingly as a store of value by by governments, and it's a decentralized asset not controlled by any one government, and that provides geopolitical resilience as a reserve assets to governments, which is increasingly appealing. Now, a big concern for investors is often Bitcoin's volatility. As we can see here, Bitcoin's volatility has been declining over time as it's more widely adopted. In its early days, its volatility exceeded 200% a year, up to 250% a year. But as we can see on this chart today, Bitcoin's volatility is between 40 and 50% a year. Now, if you think back at about gold, which is an established and trusted store of value, back in the 70s when the dollar went off the gold standard and gold was no longer tethered to the US dollar, and it started becoming an investment asset. And at that point, people didn't know if it was going to succeed as a store of value. And if you look at the trading of gold from the 70s up until the early 2000s, it too had a volatility profile similar to Bitcoin. So Bitcoin is following a similar volatility profile and similar adoption curve. And as it becomes a more institutionalized asset, its volatility is declining, and we believe that will continue to be the case. And even though it remains volatile today, here you can see a chart of Bitcoin's volatility versus Tesla, Nvidia, and Meta, which are widely held tech stocks in investor portfolios. And you can see that today, Bitcoin, which is in green, already has a lower volatility profile than Tesla and Nvidia, and it's close to Meta's. This is a fact that sometimes surprises people. But as volatile as Bitcoin is, it's on par with some of the widely held tech stocks in investor portfolios. Now, I think this chart is what I call 35 trillion reasons to own Bitcoin. This is the US federal debt, and this level of debt is unsustainable. We saw Elon Musk and Doge trying to find ways to rein back government spending, and haven't been successful at doing so. The government budget is eating up other government programs, and the only way to service this debt is to continue printing dollars. The dollar has lost over 50% of its value over the past 40 years. And so Bitcoin's cap supply is a hedge against the dollar debasement to protect wealth. Now here's Bitcoin's role in a portfolio. Bitcoin's characteristics are that it has high potential growth, high volatility, as we spoke about, deep liquidity, and low correlations to traditional assets. And according to modern portfolio theory, if you put an asset with those characteristics in a portfolio, it raises the efficient frontier and leads to better risk-adjusted returns, which is exactly what we see here. You see here the first line is a traditional 60-40 portfolio, and then you have subsequent iterations adding 1 to 2.5, 5, and 10% Bitcoin. And you can see that over the past 10 years on a quarterly rebalance, if you compare the portfolio with 5% Bitcoin to a traditional 60-40, its annualized return basically almost doubled from 6.7 to 11%. But the annualized volatility of the portfolio only went up from 8.6% to 9.8%, meaning that the Sharpe ratio expanded significantly from 0.5 to 0.9, while the max drawdown of the portfolio didn't increase significantly, went up from 22 to 25%. So this is what you want by adding an asset to a portfolio. You want it to raise the asymmetric risk and return opportunity of the portfolio, and help the portfolio with diversification, increase the Sharpe ratio of your portfolio. And this is exactly what we see with Bitcoin. Now, let's talk about the outlook and catalyst for Q3. First catalyst is the ongoing institutional adoption of Bitcoin. Here we see some of the most established financial institutions, Bank of America, BlackRock, you see the CME, Charles Schwab, Goldman Sachs, JP Morgan, you name them, and you can see the different aspects in which they are involved in crypto, whether it's crypto trading and custody, private crypto fund solutions, the ETFs, and payment payment solutions, tokenization, and you can see that the majority of these institutions have at least one initiative in crypto, and many of them have multiple. So this really showcases how institutions are getting involved in crypto as we enter the mainstream era of crypto adoption. Now, as we talked about, we are receiving good news from the regulatory front. In July, we had the Genius Act, which is a stablecoin focused act, pass both the House and the Senate, and has already been signed into law by President Trump. This will catalyze the commercial adoption of stablecoins. It'll enact clear regulations for issuers, consumer protections, and this is really what is going to facilitate the mainstream commercial adoption of stablecoins and enable them to scale from 250 billion today to projections in the trillions by the end of the decade. There's another major act, the Clarity Act, which is a broader bill that covers market structure. It defines the difference between a security and a commodity, the jurisdiction that the SEC and the CFTC has in determining this for crypto assets. It creates rules and regulations for DeFi exchanges and tokenization platforms. This act has already passed in the House and is now moving through the Senate, and we are optimistic that it'll pass into law as well. But regulatory uncertainty has been the top concern for investors over the years. And now we are finally seeing regulation go from being a headwind to the industry to becoming a tailwind. Catalyst number 3 is the rising global money supply. As we see here, this is a chart of Bitcoin and the global M2 money supply. And what you can see here is this chart shows a 12-week lead of money supply to Bitcoin. So as liquidity from central banks is pumped into the global economy, this flows into risk assets, including Bitcoin. And so we often see and have historically seen global M2 be a leading indicator of crypto price action. And right now we're seeing global M2 increasing and hitting new highs. We think this is positive for the price of Bitcoin over the coming quarters. Now, even as we've talked about the institutional adoption, there is still a lot of restrictions against investors accessing Bitcoin and other crypto assets. Here we see the top national account platforms, and you can see 3 columns. In red is totally prohibited exposure. In yellow is exposure that is restricted. So there's exposure allowed in some aspects, but not fully allowed. And then full exposure granted in what you can see is only a few platforms. You can see Charles Schwab, Fidelity, Wells Fargo, Mariner already allow full exposure and access to crypto spot ETFs. But many of the largest wealth platforms still do not allow or only allow limited exposure. So as these firms conduct their due diligence and their investment committees greenlight access, this will enable billions of more flows into the ETFs, which will benefit crypto assets. Today, we've already seen to date since the launch in January 2024, the Bitcoin ETFs gather more than over 50 billion in net inflows, becoming the most successful and fastest growing ETF category in history. Ethereum ETFs have also gathered over 10 billion, some among the fastest as well. And now we're seeing Solana ETFs. There's applications for XRP ETFs, for other types of other ETFs as well. So as the SEC continues to approve more products, this is going to allow investors a wider access to crypto asset exposure in their portfolios. This chart shows the 3-year rolling cumulative return of a 5% allocation of Bitcoin to a 60-40 portfolio, with quarterly rebalancing. And what you see in in the black line is the return of a 60/40 portfolio. In green is the additional contribution of the 5% allocation to the portfolio. And you can see that in every period, every rolling 3-year period, it's added positive contribution to the portfolio. So we think it's important to keep this in mind, keep a long-term allocation to and long-term horizon to Bitcoin and crypto assets, as that is how we think investors should gain access. And catalyst number 5 is tokenization, which we've been talking about in his shareholder letter this year. Larry Fink talked about every asset being tokenized, and BlackRock setting its vision for transforming finance through the adoption of tokenization. So as we've been talking about, this is a very big opportunity. It is the way to upgrade the financial system to have better liquidity, lower cost, democratize exposure. And this is a very big trend that crypto is at the forefront, and that major institutions like BlackRock and others are jumping on. And it's a huge catalyst for the space. And we're seeing the Fed odds of rate cuts increase. As we saw last week, the jobs report was disastrous, and that immediately not only were there call for action for the Fed, but the probabilities for Fed rate cuts increased as well. So we think the Fed is on its path to lower interest rates, and that is beneficial to risk assets, including crypto. Lastly, here we see the 4-year cycles that crypto has traditionally navigated. This year through Q2, we've seen Bitcoin rise 15%, and with the institutional adoption and flows into Bitcoin ETFs from the demand coming from Bitcoin treasury companies, from governments and other institutional investors, we expect Bitcoin to see a strong rebound through the end of the year. We expect the same for other crypto assets. So we are very excited about the rest of this year. So thank you everyone for joining today. It's been a pleasure being with you. If you would like more information, please feel free to reach out to myself, Juan at bitwiseinvestments.com, or go to our webpage and contact us for any way we can be helpful in helping you access the opportunities in crypto.
All right, Juan, thank you so much for that fantastic presentation and your insights. We greatly appreciate you joining us today.
Thank you.
All right. And a big thank you to all of those in attendance. You're watching Money Show's virtual expo, the value proposition in value investing. Stick around. We have more great content coming your way. Thanks for being here.